Welcome to the deep dive.
Great to be here.
So, today we're tackling something pretty interesting. It's this idea that the strategies you normally rely on, they might actually, well, backfire on certain days.
Yeah, we're digging into Mansi's Trading Tips 64. And the core message is simple. What works most days? Beware, because it might really cause problems on specific event days.
Okay, event days, let's define that. The source mentions things like election results.
Right. Also, RBI and Fed meeting announcements, company quarterly results days, and when major economic data gets released.
Got it. So our mission really is to understand why. Why does a perfectly good strategy suddenly become, well, risky on these days?
It does seem a bit counterintuitive, doesn't it? You've got something that works, you trust it, and then suddenly, nope.
Exactly. So why? Why do these specific events mess things up so much?
Well, I think a big part of it is how these events just inject a huge dose of uncertainty into the market. They change the whole psychology, sometimes very rapidly.
Okay, like take election result days.
Perfect example. Usually, markets move on trends, on gradual shifts. But an election, that can rewrite the entire economic or political outlook almost instantly.
Total game changer, potentially.
Right. And the lead up is full of uncertainty. Then the result itself might be a surprise. That combination can trigger these huge sudden swings that just overwhelm a normal strategy built on predictable patterns.
So the usual logic just gets paused, kind of.
Sort of suspended, yeah. And it's similar with the big central bank meetings like the RBI or the Fed.
All right. Interest rate decisions, policy statements, those always seem to make waves.
They absolutely do, because these banks are essentially steering the big economic ship. When they make a move or even just signal a future move, everyone reacts.
So your strategy that was based on, say, the current interest rate environment.
Exactly. It could be instantly outdated. And crucially, the volatility itself often spikes around these announcements. Just the level of price fluctuation changes dramatically.
Which can be poison for strategies that rely on calmer waters, I guess.
Precisely. Strategies designed for low volatility can get completely wrong-footed.
Okay, so macro events, big picture stuff. But the tip also mentioned quarterly results for individual companies. That feels a bit more specific.
It does, but the principle is similar. It's about unexpected new information hitting the market. You might have a stock you really like, solid company, good track record.
You've done your homework.
You've done your homework. But then their earnings report comes out. Maybe they missed forecasts. Maybe their guidance for the future is weak.
Or maybe it's a huge positive surprise too, right?
Sure, it can go both ways. But even a slight miss or beat compared to what the market expected can cause really sharp moves in that one stock's price.
So even your carefully researched plan for that specific stock can suddenly be in trouble because of that immediate reaction.
Yeah, the market reevaluates based on that fresh piece of data very quickly. And your standard approach might not be equipped for that sudden reevaluation.
Makes sense. And the last category was economic data release days, like inflation or unemployment numbers.
Right. These are like regular checkups on the economy's health. Investors watch them incredibly closely because they influence everything: expectations about future growth, interest rates, company profits.
The whole outlook.
The whole outlook. So if a key number comes in way off from predictions, say, inflation is much higher than expected, you can see markets react very sharply, very broadly.
Across different assets, not just stocks.
Oh, yeah. Bonds, currencies, commodities, they all adjust as investors digest what this new data means for the bigger picture. Again, your strategy, maybe based on a forecast, suddenly faces a different economic reality.
So bringing it back to that warning in the tip, beware, the real danger is just blindly applying your everyday strategy on these specific high-impact days.
That seems to be the core message. You're stepping into a potentially much more volatile, much less predictable environment. Sticking rigidly to what works on a normal Tuesday could mean, well, bigger losses.
Or maybe missing opportunities because things are moving too fast for your standard setup.
That too. The increased volatility and the potential for really significant rapid shifts just demand, well, a different mindset.
A different approach. It's not necessarily saying never trade on these days, maybe, but be extremely cautious.
Exactly. It's about recognizing that the game changes on these event days. The underlying assumptions of stability or predictable trends that your usual strategy relies on, they might just not hold up.
So you need to be more vigilant, maybe more flexible, perhaps reduce your exposure, or even step aside entirely, depending on your risk tolerance and strategy.
That's the implication. Heightened uncertainty equals heightened risk if you don't adapt. You need to acknowledge the landscape has shifted, even if just for that day or that period.
So the key takeaway is clear. Identify these event days on your calendar: elections, central bank meetings, earnings season, key data releases, and approach them with extra caution. Your standard operating procedure might need a serious rethink.
Definitely. And that actually leads to a good question for you, the listener, to think about. Beyond finance, where else do these kinds of event days exist in your world?
That's interesting. Moments where the normal rules seem to bend, or where big, unexpected shifts are just more likely.
Yeah, could be in your industry or personal life, maybe even hobbies. Thinking about how you might spot those times coming and adjust how you navigate them could be pretty valuable.
A great thought to reflect on. Recognizing when the usual rhythm is likely to be disrupted.